Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz, powered by CNBC TV 18 Season 3. This week we're at the Navi Mumbai campus of India's first and only public listed KPO company, eClerx Services. eClerx Services is India's first and only public listed knowledge process outsourcing company. Incorporated in the year 2000, the company provides critical middle and back office operations support through data management, analytics solutions and operational support. NSE FinWiz visited eClerx Services in Mumbai with the country's finest experts to advise and educate the young employees on investments and financial planning. And we're now joined by our two very special experts. We have Gaurav Mashruwala, who's a personal finance planner. Welcome to the show, Gaurav. And we have Harshvardhan Rungta, who's a certified financial planner with Rungta Securities. Welcome to the show, Harsh. Before I come to you, Harsh, for the first question, just like to let the audience know our core topic for today is gold investments. Harsh, let's start off. I want to talk to you about gold by way of how important is it to have gold in one's investment portfolio? Is it necessary to be invested in gold?
Yeah, well, Sumit, if you look at our investment habits over the centuries till date, gold has been one source of one product which people like to invest into because it is a physical asset. You can hold it, you can feel it. It is a universal currency, and you can encash it immediately. Now, when we come into modern era, if your question is specifically what importance does gold have in your investment portfolio? Well, you need to have gold in your portfolio. There is no doubt about it. Okay. The problem is when you overdo, the allocation towards gold goes way beyond than what it should be. Ideally, what we suggest when you invest into gold, what we mean by when we say invest into gold, we don't refer to jewelry. Jewelry is for personal consumption. Okay. And that should not be considered ideally as an allocation into gold. So if you're saying you have 100 rupees to invest, then 10% of that could be into gold, but not beyond that.
Okay, cool. So Gaurav, like Harsh said, so jewelry shouldn't be counted as investment in gold. It's more of a consumption, which is one big myth here. We're going to get beaten up by our wives and mothers and the other women in the house.
I'll blame it on you.
Oh, blame it on me, of course. But then if we are investing, we should be investing in gold. How do you decide what percentage? What percentage of my total portfolio should be in gold?
So Harsh already answered. He said about 10%, 8 to 10% is an ideal way. So this is kind of a ballpark figure, and which I completely agree. However, you will have to look at your existing asset allocation. Number one is how much is into debt, how much is into equity. Number one. Also look at, and then gold number three, or as part of it. Also, why are you putting into gold? So is it just to have a balanced portfolio, or is there any marriage in the offing, or is there something for which you will require gold? That's the second criteria. Third criteria is that does family already have a gold? So look at that as well, because many times it's like family has gold and huge amount of gold, and invariably we inherit that because that's one asset class which normally people don't sell off. So equity buying, selling is more or less fine, fixed deposits mature, but gold is invariably gets on to next generation. So if family already has that, it's your parents who have it, or you're going to inherit. So keep all these factors in mind before picking it up, because it should not happen that we go overboard with gold. So family has huge amount of gold, and then our grandparents also have it, and then we end up looking at 10% of our portfolio. So be careful on that. Otherwise, 8 to 10% of gold as a part of overall portfolio is fine.
So now we get gold in the electronic form, so e-gold. So is that a great way to invest compared to maybe buying coins or bars of gold as an investment purpose? Is that a good way to go through gold ETFs, e-gold, things like
that? Actually, this is a very interesting question, because not many people are aware that there are multiple options on by which you can hold gold, you can buy gold.
Right.
Most traditional form is through gold coins, that we go into a jeweler's shop, we pick up something. You're aware there is a making charge over and above the cost of the gold. Now, if you're talking about investing into gold, there are different forms under which you can invest. So the first one being, as we spoke right now, is a gold coin, which is a physical coin in your hand. There is a cost of storage. There is a risk of losing it. There's a purity risk. Okay, you have certified gold, but in case, what if it does not turn out to be the 99.9% or whatever that you've chosen? Convenience is one aspect under which you have different options. Now you have a gold ETF. What is a gold ETF? It's an exchange traded fund. So you can buy it in a demat account. You don't need to hold it physically. There is no problem of purity because it is certified and you know what kind of quality you're getting.
Great. Okay. Akshit Karya. Gaurav, his question is, can gold funds equally give returns as physical gold? Are those funds monitored by the SEBI? What's your thought on that?
So here, the valuation is based on the valuation of gold, number one. Any mutual fund is under the guidelines of SEBI. So if your question is that can gold fund manipulate and do something beyond SEBI guidelines, and the answer is no. Your question on is there a physical gold which is backed? Yes, it is. So all gold funds are backed by exactly the same amount of gold that is kept with the custodian. They are clear-cut guidelines. So there cannot be a situation where you are purchasing a gold fund but there is no backing of gold, or they are violating. So somebody could be manipulating and that's kind of an offense, but otherwise all mutual funds are regulated by SEBI, including gold funds, and they have to adhere to SEBI guidelines.
It's time for a short break here on NSE FinWiz, powered by CNBC TV 18 Season 3. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3, and today we're at the Navi Mumbai campus of eClerx Services. Gaurav, talking about not putting all the eggs in one basket. So that is one term that we love saying, which is asset allocation and diversification, which is also a key pillar, another great important part of personal financing. But simple terms, what is diversification? What is asset allocation? And I've heard there's a thumb rule. Do you agree with that thumb rule?
Anybody knows that thumb rule? Okay.
Okay.
So good. So don't go for that thumb rule. In any case, it's not valid. So it makes your life easier. Many times what we hear is that younger you are, you should be putting more money into equity. When you keep growing, reduce your equity component, and that's not true. You need to look at what are you saving money for. If you are saving for an event in life, which is going to happen at the end of 2 or 3 years, pick up a debt-based instrument. Now, I'll try and give you some examples of what is debt-based, because debt, again, could be a kind of financial jargon for few. So, a fixed deposit is a debt-based. Any kind of investment where you get interest, except debt funds. Debt funds is again a product where you get dividend. So, put into those instruments. You can put in fixed deposit, national savings certificate, though they have a longer maturity. There could be recurring deposit, there could be some bond, some debenture. But if you are saving for an event which is likely to occur in next 2 to 3 years, you pick up a debt-based instrument. If you are saving for something which is going to happen after 7, 8, 9 years or beyond, look at equity. Now, equity is an asset class. There are various ways to invest. I mean, we had a couple of friends putting up their hands saying that they invest in equity directly. So that's one way. You can directly go and pick up stocks from stock market. Another way is equity mutual fund. So nobody invests in mutual fund, we invest through mutual fund. And it's very, very important to have this thing clear, because invariably we feel or we get questions where people feel I'm investing into a mutual fund, I'm investing into insurance. We never invest into it, we invest through. So through mutual fund, you can invest into stock market. Through mutual fund, you can invest into gold. Through mutual fund, you can invest into bonds, debentures, which are debt-based instruments. So if you are saving for something which is going to happen, which the event is likely to occur after 7 to 9 years or beyond, And the 7 to 9 years is what I feel. There are some who recommend 5, some who recommend, but basically people are saying that if it's 1 or 2 years, equity is not the place that you put it in. So if you're trying to do that, then that much portion will go into equity for an interim period, make a combination. So it's like in your overall portfolio, you will have certain amount of debt, you'll have certain amount of equity, you'll have certain amount of gold. A normal saying that goes is that if part of your portfolio is not giving negative returns, you are not diversified enough.
When we're typically planning our portfolio, or when I'm calculating the net present value of how much I need to invest today to have a particular amount, say 20 years down the line, the inflation rate that we take. Now, typically we take 5%, 6%, saying that's what it has been. But do we become pessimist and say let's take an 8% when I'm calculating how much money I need to invest, or do I become a little more optimistic and say it's 6% today, it'll be probably 4% at an average over the next 20 years. So what do you think is the right number for the inflation rate that you should take when planning your portfolio?
Sure. Harsh, you want to do that?
Well, Rajat, what you've asked is a very important question as to what rate do you assume, because that is going to determine what money you're going to accumulate. Well, it's always better to be pessimistic, to think that why not prepare for an inflation rate to be 8% and have that excess money in case inflation is 4% over a period of time. Second element, when we're talking about 8% is general inflation rate. Now, if you break it up into smaller parts, the food inflation, the education, the medical inflation, their figures are far more than 8%. So the benchmark, I mean, when you get into the details, obviously you'll find the education and medical inflation is far more than 8%. So when you talk about CPI, I would suggest personally that you be pessimistic in your approach. There's no harm in having more money that is with you. Overall, when you start planning from today, you will take the worst case scenario, which possibly would be 8%. After which, you have to keep in mind that there is going to be inflation even after you retire. Inflation doesn't retire with you, right? So you need to make some provisions. You need to have some investment options which help you beat inflation even then.
We all have our goals divided into our needs and desires. So how do we have a fixed percentage allocated in our savings that this particular percentage goes for the need and the other in the desire? Is there any ratio for it?
So here it is, there are two ways. One is, the logical is that first allocate entire thing for your needs and then go for desire. That's number one. Alternatively, prioritize. Pick and choose, because it's up to you. You have to decide that this is my priority. So you can either prioritize one way. Second is do all your needs and then desires later on. Third is that you can probably pick up the near-term needs first and then the desires and then the long-term needs later on.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. I have two very special guests with me, Gaurav Mashruwala and Harshvardhan Rungta. Harsh, I want to talk to you about debt now. Debt is, again, should be an important part of, an important component of one's portfolio. And there are multiple ways to do that. So when we've spoken about fixed deposits, but another way of adding to your debt portfolio is these new schemes that the government, sorry, not new schemes, but like PPF, which is obviously an old essential part. But sometimes people say that I don't want to invest in PPF. I get it in my salary. Part of it has, mandatorily gets cut into that. But otherwise, what about things like PPF, NPS? How important should they be to get to invest in?
Well, what is debt? So Gaurav gave you some bit of information as to what is debt in the initial when we started off. So, within the debt space, there are two kinds of products. One that gives you a fixed coupon payment. Your fixed deposit is a fixed coupon payment. You know exactly what you will get after 1 year, after 2 years, or whatever period, because there is an interest rate attached to it. Now, there is another kind of investment which does not tell you what exactly will you get, because it's on a floating basis. which is a debt mutual fund, for example, which could be your NPS in that category does not tell you exactly what you will get. PPF tells you exactly what you will get, right? So there are two kinds of debt investments. Now, which one should you take? Why you should take is a different question altogether. At one place, you know what you will get. In an NPS, the PPF, for example, tells you that I will give you 8.7%. This is the interest rate which is fixed, and this is what you will get for that particular year at least. NPS, on the other hand, is a product which basically is helping you to, at the time of retirement, it helps you get pension. What returns will you get out of it? That depends entirely on the performance of the fund in which you've invested. So you need to have assets in your portfolio matching with your time horizon. So if you have any requirement which is immediate in nature, you need to have debt. If you have something which you can wait for a longer period of time, you need to have equities. In the interim, you can start with a balanced kind of a fund when you have a portfolio, single fund which balances itself between equity and debt. Yeah. So answering the query whether debt is important in your portfolio, I believe there is no choice. We all have short-term requirements. If you have short-term requirements, you need to invest into debt.
For example, I'm having rupees 1 lakh at this point of time. So how should I diversify my fund in 3 options, like mutual fund, equity, and the gold scheme which you shared with us, like e-gold and all?
First, I already answered the part of it that we never invest in mutual funds. We invest through mutual fund. So mutual fund is not an asset class. Your investment will be into either equity, direct, or through a mutual fund. It could be into gold, direct, or through mutual fund, or a debt, which is bond, debenture, a few other instruments, either direct or through mutual fund. So we knock mutual fund off. And then we look at that if you have a lakh of rupees today, how would you do it? Decide your goals. And if your goal is that you need money for higher education in 6 months' time, then the only option that you have is a fixed deposit, because you require that money in 6 months' time. But if you are saying that I don't need any money for 7 or 8 years, it should be either direct equity or equity mutual fund. So it does not matter. I mean, there cannot be a situation where there can be a thumb rule applied.
We all find ourselves in a situation wherein we have to take a loan, be it a personal or a gold loan, right? So the point one here is, like, we have a lot of banks, institutions which are giving gold loans now. So which one is a better option? Is it a personal loan or a gold loan? And how does it relate to the fluctuating cost of gold and the tenure for which I'm paying those EMIs and the interest?
Harsh, you want to take that?
Yeah, so your question is, if you're in need of a loan, should you go in for a personal loan, or you should take a loan against the gold which you already own? Well, if you look at the interest rate, first comparison would be what rate of interest are you going to pay for a personal loan vis-a-vis what rate of interest you're going to pay against a gold loan. Now, your specific question to gold loan, how does it work? Okay, there is a value of gold which is ascertained at the time of lending, which a gold finance company would do, or a bank would do for that case. There is a margin which they keep, okay, which was earlier mandated to be 40%. So they would lend you. RBI had, some time back come out with a regulation saying that you cannot lend for more than 60% of the value of the gold, which I believe they have now got it back to 80%. Now, that is the margin that the lending institution will keep with themselves. If the price of gold when you borrowed was, say, 10,000 rupees, just for calculation purposes, and you've got a loan for 8,000 rupees, if the value reduces to 9,000 rupees, that's the market value, the gap has been reduced, a 20% margin is still not maintained. So you will have to make good that margin. The bank will, or the institution will call upon you to make the difference, make good the difference. So which could be either in the form of lending more gold or repaying that part of money back. So interest rate is going to be the factor. The purpose for which you require, I'm sure personal loans are not available for 5 or 6 years at one stretch. Gold loans you could possibly roll over for a longer period of time.
Well, that's all the time that we have. Thank you so much, Gaurav. Thank you so much, Harsh. Thank you so much for having us
here. This was a very interactive session. I had the opportunity to actually attend such sessions and gain a little bit of knowledge more about where I was lacking. Though I am not from the finance background, I am a telecom engineer, a telecom professional, you can say. So right now I've joined in digital marketing. So this is something new, something out of the box. So it was a nice experience, I guess.
today's session was very helpful to us. Mr. Gaurav and Mr. Harshvardhan taught us a lot about what exactly stocks are and how we can invest our stocks and how we can take our money in a good direction ahead.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But here's a chance for you to win a cool goodie bag by answering this viewer question.
What is the best way to invest in gold for the long term? Buy jewelry. Buy gold coins. Buy e-gold. Don't need to invest in gold. Send in your answers at fwq@network18online.com.
The correct answer to last week's viewer question is Option A, term plan. Many thanks to all the viewers who sent in their replies. The winners to episode 5's viewer question are Prasad Kulkarni and Neeraj Singh. We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.